So I never had good luck with slides. Ever I was a high school student and I had to prepare them for class. I usually was too lazy to prepare them, and then I had every single excuse why I didn't have slides. Now fast forward 20 some years, when I actually do prepare them because of formatting and email and bad connection, etc., the slides get lost. So I think slides are not my thing. So forgive me for not having any, but I'm always happy to follow up by email and send you the presentation that did not quite make it on that big screen. So a few words about myself. My name is Julian Zegelman. Although I spent the last year and a half pretty much on a plane, when I'm not traveling, I do live in San Francisco, and walking around Amsterdam today actually reminded me a lot of San Francisco. Beautiful city, very windy, a lot of water. So the things I want to talk about, I think that are very dear and near to what I do every day and what I used to do. I used to be a corporate and securities attorney in California, in Silicon Valley to be exact. I first got exposed to Bitcoin and the cryptocurrency space in 2014. I started representing clients in this space, built a quite active legal practice, and then probably circa 2016, I worked up enough courage to start investing in Bitcoin and crypto assets, and told my wife that it's not all a bubble and we're not going to lose our life savings, and became a quite active angel investor in blockchain companies. Some of my early investments include Shapeshift, Filecoin, Bitso, BTC Gem, and some other companies. Some of them went out of business in a glamorous way. Some of them actually still around and doing quite well. As a result of all my angel investing and the desire to do something new, I joined a venture capital fund that's entirely focused on blockchain investments. The fund is called TMT Crypto Fund, and I actually have some of my partners here with us today, and they're going to talk about something a little different. But the thing I wanted to talk about is what's happening in the regulatory framework and how does it affect the blockchain business, be it the future of Bitcoin, be it the ICO market, be it the actual implementation of blockchain in enterprise. So I'm going to talk more about the U.S. perspective, not because everything begins and ends in the U.S., but because whether we like it or not, the United States, per the latest CoinDesk research, actually accounts for 40% of the ICO market and for about 35% of the actual revenue in B2B blockchain. So in other words, the actual use cases for blockchain technologies today, the ones where you can try the product and it actually makes revenue, boringly enough, is in business-to-business applications, mostly in very boring and old-fashioned things like insurance, money transfer, banking, data storage, etc. And the total market size, I believe, was only $2.5 billion in 2017, which is actually dwarfed by the ICO market, which, when you count all the forks, was, I think, closer to 70 billion. But funny enough, only 5 billion of that were actual token sales, and the rest of it were the massive cryptocurrency forks that happened. So a fork is a wonderful business idea. Anybody out there with your own cryptocurrency, launch it and then definitely fork it and fork it again. So what is actually happening? So in 2016, the entire cryptocurrency ICO market was just a little north of 300 million. Sounds like a lot of money, but to regulators, it's not even a blip on the radar. They don't even see it. You know, when you compare it to some other markets, it's completely irrelevant. In 2017, the market quickly grew to over 2 billion, and that's when the Securities and Exchange Commission, the CFTC, which regulates options and futures in the United States, and other regulatory authorities, both in the US and Asia and Europe, started to get interested. Well, why did they start to get interested? They started to get interested for two very basic things that get every government exciting. It's money laundering and taxes, right? Governments throughout the world don't really care too much about crypto anarchism. They care about the bad guys, whatever the ruling ideology says is a bad guy getting money, and they care about the good guys paying taxes, and the bad guys paying taxes too before they go to jail. So having said that, pretty soon the regulators started to look down at this new and emerging market, and they realized that there were a couple of things happening. One was that a lot of those token sale companies and a lot of the crypto exchanges were in fact becoming money transmitters, right? Money or monetary equivalents were moving from point A to point B without being licensed or regulated or going through the usual know your client and AML, anti-money laundering regulations. Another thing they started to be aware of is that a lot of folks were getting glamorously wealthy buying their Lamborghinis and surprisingly not paying taxes. So the amount of Lamborghinis in Miami Beach increased, while the amount of taxes paid by Miami residents stayed about the same. And thirdly, a lot of the token sales started to look and smell and advertise and trade and crash a lot like securities do, except that nobody was regulating them. In the beginning of 2017, the Securities and Exchange Commission did not have a single person regulating ICOs. There was just no department. There were a couple of enthusiasts who kept on talking to their big bosses and saying, look, 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 there's this crazy thing going on. Let's get involved. And the big bosses were saying, it's a small market. And all of a sudden, the market became $2.5 billion. Certain things like the Dow disaster happened. And the SEC said, well, let's start with 3 people. And by the end of 2017, to my knowledge, the SEC enforcement department grew to actually 50 people, and they're still actively hiring. And a lot of the young attorneys, guys and gals at the Securities and Exchange Commission want to get on that task force because A, it's exciting, and B, they have a lot of work. So what does it mean for all of us in this room? And I want a quick show of hand. How many of you are in the Bitcoin business? I mean, miners. Okay, how many of you are in the software development, blockchain, open source build? Okay, and then who has done an ICO, is contemplating an ICO? Okay, and is the US a potential market for you? Okay, so everybody, okay, we'll touch on that privately. So what is happening and what does it mean for the blockchain business? So a couple of things started to happen. First of all, the SEC came out with a few circulars, and while there is no comprehensive legal framework applicable specifically to token sales, there is a lot of individual cases as well as guidelines that said in no uncertain terms that the presumption is that your token sale is a security in the US. So if you advertise to US residents, if you trade on an exchange that is open to US residents, if your company is based in the US, or if there is any other connection to the US jurisdiction, the presumption is that that token you sell is a security. Well, what is one of the key things I think that really drive that test today? The key thing is, what does your token do? The SEC came out with an explanation and said that, well, it doesn't matter if in your white paper or your token design you describe what's called a utility token, which is really a piece of software like a Kanye song on iTunes or an online game, etc. What matters is what happens when somebody sends you cryptocurrency or fiat money for your token. If at the time when they do it, your network is not launched and the token cannot be used in a functional way, even if when you build it and you launch it, it is a functional and it's what's called a utility token, it doesn't matter. You're still selling a security and it remains a security for the duration of the token life. Well, what does it mean? It means a couple of things. First of all, companies that sell those tokens have to either register the issuance of tokens with the Securities and Exchange Commission in the US if they touch the US. And exchanges, and this is the biggest problem, exchanges that list those tokens have to be licensed exchanges with the SEC and have to follow all of the rules applicable to security exchanges, which clearly does not happen today. In the United States, last I checked, there's really only 3 exchanges. Not a single one of them touches altcoins that are even licensed as an alternative trading service. Coinbase is one of them, and there's 2 much smaller ones. So the biggest crackdown that already started actually started at the top down. It started with the exchanges, because when the SEC looks at this landscape, they realize, and they're smart, that folks, they're doing their job like they're supposed to. You can't really chase 2,000 ICO companies. That's way too many companies. What you can do is you can chase the service providers, the attorneys, the advisors, the accountants, and most importantly, you can chase the exchanges. And so most of the exchanges, whether they admit it publicly or not, actually got subpoenaed by the SEC. And the SEC is looking at things like Who are they listing? What criteria are they using? Are they selling to U.S. residents? Are they doing their KYC and AML? And most importantly, I think the ugly truth in the room that people don't like to admit is that this is an unregulated market that's very prone to manipulation. There's a lot of pump and dumps. There are a lot of other things that are going on. Some of the insiders in the industry are aware of. Some of them, I mean, people come up with amazing things every single day, and that's one of the things that I think gives the SEC the most heartburn. So what does it mean in terms of industry? I think one of the biggest trends we're starting to see is two things. I think we see a split in the investment approach to token sales, right? I think in 2016 and 17, similar with cryptocurrency, there was only one approach. If it has the word crypto or blockchain or token in it, buy it with a discount or buy it on the listing day, hodl it for a bit and then sell it with a profit, repeat, repeat, repeat. Nobody really thought too much about liquidity. Most of the exchanges were actually chasing the tokens to list, and it was a very easy and quite financially rewarding business. And a lot of the VCs were walking around, sadly, thinking that they're going to be out of a job, at least in the blockchain sector, because more often than not, a blockchain company would tell a venture capital fund that, we really don't want the dilution. We don't want an adult on our board of directors. We don't want your advice. We don't want your money. We can do an ICO, raise all the money we need, build a business, and go on and go on. Well, the regulators are the VC's best friends, and I think my partner Igor, who's here, is going to talk a little bit about the criteria and build a case for venture capital and blockchain. But I wanted to talk a little bit more about what the future, the regulatory environment is looking like. Well, the one thing that's definitely becoming clear is that the exchanges are either going to consolidate, so we're going to see a lot fewer centralized exchanges. We're going to see some of the guys who are implicated in the most trouble that you really can't fix go out of business, and probably go out of business in a rather spectacular blow up. We're going to see some guys getting licensed and continue operating very similarly to the way that traditional stock exchanges and equity exchanges operate, and some of them may actually be bought out by the big equity exchanges. I think an interesting deal was when Poloniex, pretty popular top 10 exchange, got bought out by Circle, a largely unknown until that time fintech company that in turn is owned by Goldman Sachs. And I think, as you often see in big M&A, once somebody like Goldman Sachs buys an asset, you're going to see JP Morgan, Morgan Stanley, other big guys do the same, the New York Stock Exchange and NASDAQ. And everybody's going to say, well, I need to own a crypto exchange, but I need to own a crypto exchange that's not entirely shot in terms of its baggage and its background, et cetera. In other words, we hope Al-Qaeda wasn't buying tokens on it. Or whatever is the latest terrorist organization, I don't really keep up. So that's one trend, I think, that the mid-market exchanges are either going to go out of jurisdictions with heavy regulations like European Union, certain Asian jurisdictions, and the United States, or they're going to go out of business entirely. I think another trend we're going to see is a lot of the token sales, especially the smaller ones, or the more adventurous ones, are going to go offshore or going to trickle down to so-called decentralized exchanges. So in other words, exchanges that are decentralized, don't have a central authority point, are typically distributed among various jurisdictions, have their servers in a place that's pretty far to reach, and got that nice anarchist flair to them. And I think that the decentralized exchanges are going to grow in power and grow in their trading volumes. And some of them will get basically driven out of business, like BTCE in early 2017. Some of them may go on. I also think that we're going to see more liquidity on one hand, but then less volatility and more regulation. And I think as a result, a lot of the investing strategies that were legal, or at least weren't illegal, and were lucrative in 2016 and 17, going to start to die out and become more normalized in 2018. How much time do I have? I also wanted to do some few minutes. Okay. Another trend that I think we're going to see is that the companies raising ICOs, raising funds, are probably going to raise more money, but there's going to be fewer of them, and they're going to do so a little bit later in the game. I think a very interesting thing about 2017 was that everybody's perception of the limit in terms of how much a company might raise in a token generation event was really stretched far. I mean, everybody's talking about the Telegram offering, which according to public information raised 850 million. That's 850 million just in the first part of the pre-sale. Everybody remembers Filecoin, which raised over 250, Tezos, which raised over 150, Bancor raised over 150, etc. Some of those had an actual existing, actively growing business, like Telegram or Filecoin. Some of them didn't. But I think one thing we're going to see is that a lot more companies with venture capital funding early on probably going to build a platform, build a minimally viable product, and then go out and sell utility tokens or sell security tokens, but do it later in the game and raise more money. So I think if in 2016 and 17 an ICO was akin to a seed round of financing or a friends and family round on steroids and asset, where a lot of things got funded that probably would never get funded unless you had a crazy uncle who was also a billionaire, I think that's going to be a thing of the past. We're going to see a lot more mature projects using an ICO as both a crowdfunding tool, but also, I think, more excitingly, a marketing tool as an ability to really cater to their user base, advertise to their user base, and fund their growing business through the user base. Those, I think, are the two biggest trends. I think we're going to see a more polarized market where, because of the rising regulatory threshold in the US, unfortunately, I think a lot more, unfortunately, as an American, I think a lot more innovation in the space will happen outside the United States. I think it will come to the US much later. And I think we will have the more mature companies still address the US market, but doing so will become more regulatorily burdensome and expensive. Having said that, I'm happy. I always like questions. I'm happy to take questions. It doesn't have to be about blockchain. It could be anything.
Any questions for Julian to start off? Is there anyone yet? I'm going to, yeah, go on.
Yes. Polymath is a securities platform, and they've got a utility token. They stopped their pre-sale, their public sale, sorry, but they performed their pre-sale. How screwed are they?
Well, I mean, again, I'm not an SEC official, nor am I an attorney for Polymath, so it's like, it's like having a conversation in college with your buddy, and your buddy's saying, my girlfriend never came home last night. What do you think? Is she cheating on me? I really haven't been there. but in general, what I think a lot, I think what, what really concerns the regulators first and foremost is fraud, right? They don't like somebody literally taking the Bitcoin, running to a beautiful island in the Bahamas, and never coming back. At least in the US, right? In the US, when you're dealing with securities regulators, there's civil liability, which could be fines or being banned from doing another token sale or acting as an officer or director at a public company. And there is criminal liability, which could be actually serving a prison term. Typically, barred absent fraud, money laundering, or gross tax evasion. Other things are civil. So I would imagine that any company that is not implicated in those three horrible things would probably get away with a fine or a rescission, which means you have to turn the money back and there is no case. This is what happened actually to Munchie. I don't know how many of you followed that case. There was a Palo Alto startup, had an existing business, decided to raise money, probably didn't think through their marketing strategy too much, came out with a somewhat aggressive marketing. On the third day of the token sale, got contacted by the SEC, agreed to give everything back, probably ate all of the marketing expenses, so it wasn't quite a zero neutral game. They probably lost money, plus lawyer fees are not cheap. I'll tell you as an ex-lawyer myself. But there was no criminal liability, right? So I think the talks about, oh, you cannot do a cryptocurrency business in the US, oh, it's criminal, oh, if you do an ICO in the US, you go to jail, it's exaggerated, right? But the regulatory burden is definitely higher than the regulatory burden in the EU and much, much higher than some other jurisdictions. But that was a good question.
Cool, thanks.
Other questions?
All right. Do you think old economy VCs are going to catch up with the blockchain wave, and when are they going to start really looking into a blockchain as a focus?
Well, absolutely, and there are already. So I'm more of an emotional investor than an economic one. I was horrible at math. That's why I first became a lawyer. Really wanted to become a writer. That didn't quite happen. And became a venture capitalist. So think about this. In 2016, the total amount of VC funding that went into blockchain startups was 40 million. The total amount of ICO was about 300 million. And DAO and Ethereum token sales were, I believe, the two largest ones. That's 2016. 2017, again, it's actually free. There's a beautiful report that CoinDesk just came out. It's free. I get no commission from it. It's long. It's 120 pages, but it's well worth it. It has a lot of cool verified statistics. So per CoinDesk 2017 State of the Blockchain study, by the end of the year, and I think they cut out the statistics as of late December of 2017, total VC funding into blockchain was already 200 million. So you can see just in 1 year, it grew fivefold, which for VC is a lot. My prediction is it's going to continue to grow just because statistically, even Telegram itself, per data out there that may or may not be true, had a lot of traditional VC money in it. I think VCs are typically a little bit slower to catch on, but looking at the dot-com era, for example, or some other phenomena where a certain technology became hot all of a sudden, you're going to see a lot of Me Too investors, a lot of VCs doing offshoots of their funds playing on the blockchain. I think the first ones to come in, which was interesting, were actually hedge funds. Hedge funds just jumped all over the space in 2017. They were more interested initially, of course, in Bitcoin, Ethereum, and the more liquid cryptocurrency trading. Some of the larger ones actually allocated money to token sales. Some began to do some more VC-style investments. I know just from talking to a lot of my peers that in 2016, a lot of them were looking at this as a bubble and saying, well, it's going to burst, it's going to burst, it's going to burst. 2017, a lot of those guys are hiring junior partners with blockchain expertise and raising new funds focused on the blockchain. So yes, absolutely. I think there's going to be more VC money flowing into this sector.
So Julian, I'm going to throw in a question with, it's the same question, it just has two parts, one looking from a higher level and one more specific, but it's the same question in a different form. Mr. Clayton from the SEC, he said recently, last month, that he's never actually seen, he doesn't know about a utility token, that it doesn't exist at all. So is he right? Do they really mean it? How does it look? How does that look from their point of view, considering the fact that in 2017, out of the billions that were raised for new projects, 80% of them are for non-financial applications. So then part two of the question, from a more practical level, he also said that they're going to start to come after, to start to investigate some of the ICOs that have been seeking to capitalize on the perceived promise that the value of the token will go up. So what does that actually mean from a lawyer's perspective? What does it mean, capitalized on the perceived promise? Because that's not something that would necessarily even be stated in the website or in the documents. It would be perceived by who? Perceived by Mr. Clayton? Perceived by the buyer? Perceived, how would you, basically how do you launch a utility token in the US?
Right. No, I think great question. If I may, I'm going to break it down to, I think, 3 themes, right, that are going on here. Well, the first theme is that in the United States, we have precedential law where basically we're relying on old cases that create precedents, and until they're overturned, they're the law, right? They're not codified, it's case law. The case that drives the determination of whether an instrument is a security or not is Howey versus the SEC, which is actually over 40 years old. It's got a couple of factors, and one of the factors is there an expectation of profit? It's not a determinative, but it's a pretty heavy factor. In other words, if you sell an instrument and the purchaser expects that instrument to rise in value and there's a speculative intent, it's more likely to be a security than not. The problem is when you take 40-year-old case law and you try to apply it to rapidly changing technology and new phenomena, there's a lot of uncertainty. So when Mr. Clayton says that he's never seen a utility token, the question is, well, what is a utility token? There is no such definition. The entire term comes from a 2016 paper by an industry group. I believe it was a collaboration between CoinDesk, Coinbase, and a large law firm in the United States that tried to make sense of everything that was happening, right? It's not a legal term. It's not, as of now, defined in any case law. I think there are examples that raised funds for tokens that were useful on the day they were done. For example, you think about Ethereum, right? On the day when you bought an Ether, presuming that the main purpose of Ether is to be an electronic storage of value, you could send it to someone and deliver value. When Kik, the messenger, launched its own cryptocurrency, it essentially, the big picture view is it swapped its internal virtual currency that was operative and had value and allowed you to run transactions inside the messenger and do things like buy a better looking avatar for tokens, right? So it had utility. So, I think that point is up for argument. The point that the majority of the token sales happened because of the speculative intent, I think that there's got to be some regulation that will establish rules in the middle, right? Because I think it's very difficult to argue that every single token or the majority of the tokens that get out are useful, because I think the truth is, and a lot of people understand it, the regulators understand it, the more sophisticated investors understand it, the technologists understand it the best, that a lot of those projects are not sustainable. At best, they're going to have to change their business model, and instead of promising a trip to the moon, they're going to say, we're going to take you from Oklahoma to Salt Lake City. A lot of them are, it's just not going to work, or it's not going to work in the time frame they're promising. At the same time, I think that trying to force everything, like a very rapidly changing technology that doesn't have sufficient funding in VC and other sources, trying to force it into the definitions of traditional public security is going to stifle innovation and going to drive a lot of that innovation and effort from outside the US. So hopefully there is some reasonable regulation that is somewhere in the middle.
So, for example, if you want to use a token or launch a token for a video game or for Facebook likes, or where in some cases I've seen in the white paper their prospectus that states very clearly you will lose money. This is not for investment or speculation purposes. Does that cover it?
So I think the question is, how do you sell it? See, the thing that everybody gets fixated on, well, is if it's a security, it's the end of the world, right? Everybody gets fixated on that and gets fixated on saying we're not a security, but people forget that you can sell a security in the United States subject to either an exemption from registration requirements or a registration. For argument's sake, you can undertake an IPO, and instead of registering shares of stock in the prospectus, you could register tokens. You could rely on exemptions, and there's some large token sales, for example, Filecoin, that very clearly stated in their white paper that on one hand they don't think there is security, right? That's their position. On the other hand, out of abundance of caution, they only sell it to accredited investors in the US in reliance on what's called Regulation D, an exemption from a public offering. I think personally, if you ask me today, what is the best project or what is the safest project stage to take it to a token sale in the United States, I would say it's a project where either you have an existing business, right, and the network is launched, and you're taking virtual currency or loyalty points or gold coins if you have like a virtual game and you're swapping it for tokens and the thing is working on day one. I think it's a much easier proposition to defend and call a utility token, or you're treating your entire sale the same you would treat a securities sale, but the problem is not so much the primary issuance, right? Because there are a lot of legal mechanisms to conduct a compliant token sale. The problem is the disconnect between the motivation of the purchasers, which are not going to use that token most of the time. They want to sell the token on an exchange and make a profit, the exchanges, which a lot of them lack the proper mechanisms to enforce the regulations that they need to enforce to be compliant, and the SEC, which wants to make sure that there are no unregistered security sales. Which is why I see two things happening. One, that a lot of the larger projects that have the ability to drive purchasers and sell their tokens based on the size of the project, the team, the potential economic opportunity, they're silent on the topic of exchanges, listing, and liquidity. They do not, at the suggestion of their lawyers, they don't touch that, right? They don't touch that subject at all. Nobody knows when and will Filecoin trade. Nobody knows when and will Telegram trade. Nobody knows, when some of the other ones will trade. So because there is this disconnect. You can do a very compliant sale in the US as a security, but then the second your token gets on an exchange, whether centralized or decentralized, there's a lot of liability, because at that point you probably don't control who's going to buy that token, and if a purchaser is going to buy it that per the exemption you used doesn't have a right to buy it, the company in the US, I'm talking about US, right? I'm not familiar with other jurisdictions. In the US, the company most likely has primary liability for that. So.
All right, I think we're out of time, actually, but just one observation or comment on that I think often gets overlooked. The reason to do an ICO, the best reason to do an ICO is to meet the community of your users.
Yes.
So if you want to have a successful project, it's better not to find the people who are buying in order to speculate, but who are actually going to use and hold on and not dump them immediately as soon as they get a chance to put it onto an exchange.
And if I can do a 30-second plug for my business. And I think that's why if you're building a sustainable project, an ICO and a sustainable project are not mutually exclusive, but I think a good model that works in my opinion and will continue to work and grow in popularity is raise some private equity capital, right? Build at least a minimum viable product, reach out to your community, get your community excited about your project, have a clear business model, have a clear, predictable timeline for when the token will be operational, and either within a short period of time before then or after the token is operational, conduct a token sale that A, is more likely to be defensible as a utility token, or B, you're selling it to a community of users that are not going to dump it and then go out and sue you in a class action lawsuit, that are actually going to use it and build a sustainable token economics and token model. So hopefully we see more and more of those deals.
Thanks. Thank you, Julian.
Thanks so much.